In the market as well this morning to factor into your thinking too. So there's a lot going on as we await for payrolls. So let's talk about how we expect these markets to open this morning. We think it's going to be a positive story for equities. Equities are on the front foot. US equities were yesterday. We lead into the European session as a result of this on the front foot. How we finish the day remains to be seen. Volatility is really low going into this session, which is interesting as well. Anyway, time for the Friday session to get underway here in Europe. This is the picture you are contending with. It is going to be a positive one. The FTSE 100 is in the green, as is the IBEX already. We're expecting these markets to be up by 2, 3, 4 tenths of 1%. They're not big gains, but they are gains incrementally, just pushing a little bit higher. It feels like the bond market story from the beginning of the week is firmly in the rearview mirror, and we are looking forward to the data a little bit later on. So there you go. Stock 600, FTSE 100, IBEX all in the green this morning. I think we're going to see a similar story for the CAC. In fact, the CAC could be even more positive going into a weekend, obviously, of high politics in France. There you go, up by 3 tenths of 1%. We'll wait for the DAX and the SMI to settle down. Some quite disappointing data out of the German economy this morning. Just keep paying attention to those numbers because they're not great right now. That's the signal coming out of Germany. Anyway, what is the sector story? What is the single stock story? Val, what do you got?
Look, when it comes to the sectors picture, we are decently in the green. Only one in the red on my screen at the moment, and that is energy. At the top of the basket, basic resources, technology is up there. We also have autos and auto parts, and that's maybe down to this report, this German report that BMW is seeking a tariff side deal beyond the US-EU agreement. We are seeing shares of BMW in the green to start the session as well. But when it comes to the sectors, we are modestly, positively in the green. Only one sector in the red as I speak.
And you talked about tech. We've got ST Micro over in France, up 3.5%. ASML, a company the guy had flagged on the upgrade, coming through with gains currently of 2% for the maker of those lithography machines. Interestingly, that Stellantis is gaining as well, 1.8% in the auto space. But this is a tech story. And of course, we had the Broadcom piece yesterday in that partnership with OpenAI on the production of those new chips. Just on the downside, in terms of some of the individual names, you got a bit of softness coming through from Ørsted, of course, a big day for them with that vote around the rights issue. Sanofi also low by 0.8%.
So it looks like the drug makers are where the weakness is this morning in terms of the points drop. So you've got Astra, Sanofi, Novo all dropping this morning, which I think is interesting. ASML, though, is the biggest points gain on the upside. So not only is the upgrade helping, but also I think probably the Broadcom story as well. Banks aren't having a bad morning. That's interesting in the light of what we've seen in terms of the bond market story earlier on this week. HSBC is having a good session. UBS is having a fairly good session as well. I think I might have seen an upgrade-downgrade story on UBS. I'll come back to that in just a moment. But it still feels like this is a marking time, waiting for the big number that's going to come through a little bit later on today.
Yeah, that's at 1:30 p.m. London time. Non-farm payrolls report, big one for the direction of interest rates and the U.S. equity market as well. Joining us to discuss this is Seema Shah, Chief Global Strategist at Principal Asset Management. Thanks for joining us on this Payroll Friday. What's your call for today? Guy seems to think that there is not a lot of juice out there that can dent this equity market rally. Is there a print that could lead the equity market to end the session in the red?
Hey, thanks for having me on. Well, look, it's a fairly narrow path to continued upward moves. From here, if you were to get a significant negative print, let's say you're getting into a -50 or even like a low 25, I think there is potential that the market starts to really worry that actually the economic path is worse than expected. So I think the equity market may like it for the initial point, assuming that the Fed is going to cut rates a little bit more. But over time, that weakness is going to feed through. And equally, if you get a really, really strong print, but there's still a feeling that the Fed is going to cut rates, whatever happens, I think you could see some movement at the long end of the bond yield curve, and then given valuation, that's a really vulnerable moment.
What kind of strong print is that? 130? Would it have to be above something like that in order to worry the bond market?
Yeah, I think the hurdle is fairly high to change the narrative. But certainly, if you're getting above 150 to 175, which I have seen a couple of estimates suggesting that you could see a rebound, it's certainly not a central scenario. But I think if you were to see that point, and then the market doesn't change its pricing for what the Fed is going to do next month and beyond, then we start to get into a slightly dicey moment.
But at the moment, the view is that bad news is good news. I really struggle with this. The US economy is slowing down. The labour market is slowing down. But the Fed's going to cut, so that's great for equities.
I think historically, I mean, if you were to get Fed cuts into an economy which, fine, it's slowing, but it's not heading to recession, that typically has been really good news for equity markets. And I think that's what the market is saying, is that, look, yes, the economic data is weakening, but there's very, very few forecasts out there saying that recession is imminent.
Yeah.
So if you're going to now juice up the market with Fed cuts on top of that, well, look, we need to keep an eye on inflation. We need to keep an eye on a number of different things. Yeah. But that trajectory for the economy is actually fairly solid. And then for earnings, it's pretty good, too.
The market, again, are we OK post-Jackson Hole to ignore inflation? Like, is that the right thing to do right now?
No, and to be honest, I mean, I think that, look, at the moment, clearly the market is solely focused on the labour market. That is everything. But at some point, the focus has to turn back to inflation, particularly if and when you start to see some of those tariff impacts starting to feed through. Then I think the market could shift its focus. Yeah. But even from our forecast, we're only expecting inflation to rise to at most about a 3.5% level. And, you know, provided inflation expectations aren't creeping up with that, then I think, you know, you could be okay as long as the Fed isn't cutting by 50 and you don't have these kind of 6, 7, 8 rate cuts priced in. So I think that's really key at the moment. But
that's where we are right now, isn't it? We've got lots of rate cuts. Waller's calling for lots of rate cuts. Myra's telling us it's going to be deflationary. We've got lots of rate cuts priced.
Well, the market is pricing in 6 cuts to the end of next year. Our own forecast is for 4 cuts. So give or take, we're talking another kind of 50 basis points. I think that's okay. It's really about the sizes, though. So if you were to talk about a 50 basis point cut next month, we start to hear more noise about that. To me, that really is a worry because inflation hasn't disappeared. There still should be concerns. Yeah. And then you've already got that pressure at the long end. Everyone's keeping a really close eye. So it's, as I said, it's a narrow path to victory. But at the moment, at least for this month, I think things could be okay before that attention starts to shift back to other areas.
So, Seema, one scenario you mapped out was a kind of sub 25,000 on non-farm payrolls and showing real cracks in the labour market, panic, expectations of more cuts from the Fed. But, of course, there's that lag effect. Which parts of the equity markets would be most vulnerable in that scenario?
Well, so I think it's going to be clearly the cyclical areas of the market. There's been in the last couple of weeks, a number of people talking about the consumer discretionary area, saying that that's really due for some upgrades. If you start to get labour market weakness, well, I think that throws that whole story into the bin. At that point, though, I do think that the market may start to look more favourably at tech again, simply as that's the kind of the safe island. You know, against a storm, where do we want to go? We want to look at balance sheet strength, cash flow, etc., and that points you back to tech. So actually, whichever way you look at the equity market as a whole could look okay. It's just underneath the surface. As, you know, beyond technology, things might start to look a bit more difficult.
So with the gravitational pull of tech, possibly one solution in that more challenged environment, what does that mean for the US versus European story in terms of equity flows?
So we still have a preference for the US over Europe at this point. Europe has had a great run this year, but we need to see more good news coming out from Europe. I think the catalysts are fading at this point.
Guy is very worried about Germany. Yes. And to be fair, you've been you started German data. You've been talking about the unemployment rate in Germany, and then the data confirming some slowdown there today. Is that
the European story is premised on the idea that Germany's going to spend a load of money, the economy's going to take off,
so
and
2026 story, is it?
That's not showing up in the data right now.
Right, and exactly. I mean, I think I would share some of that concern. I'm not expecting a very tough, at least a very negative year for Germany by any means. But I think that given how much the equity market has run up, you need to have a continuation of fairly solid economic data. You need to have evidence of the fiscal spending coming through, streaming into areas, showing up in the right areas. So not just defence, but showing up in infrastructure spending. I think that's what investors are looking out for at this point. the good news is that the market is already assuming that the ECB isn't going to cut anymore.
Yeah.
So there isn't any, I guess, negative news on that front to come. That's already priced in. But it's really about the economic data. Where does that go? And where is that spending showing up? We need to see, almost like, you need to show me the money at this point.
Yeah.
Are there any other risks on the horizon? You think the market is underpricing? We focus on the labor market. We focus on the Fed. There's also the government shutdown that could potentially happen at the end of the month. Is that something you're worried about?
Not particularly. You know, there's always a lot of noise around the government shutdown. We always see a little bit of market volatility, but traditionally, it's very rarely is that it's a sustained negative move for the market. So we tend to overlook or look beyond that. We'd certainly urge our clients to try and ignore a lot of that noise. We've already seen this year. There's been so much noise around the government. This is, I think, is just another one of those factors. And it's really about focusing again on the fundamentals, what's really going on with earnings, what's going on with the Fed, what's going on with inflation. That's going to be the key track for the market.
And when it comes to the thought that Myron was sharing yesterday in his confirmation hearing, you know, his stance is that Trump's policies taken together are deflationary. Do you agree with that? And if not, what's the one thing that stands out to you as an argument and why that's untrue?
I struggle to see how any of those policies are deflationary. I think the one deflationary, I guess, bright spot on the horizon is just going to be AI. What does that do? What does it do for productivity, et cetera? That's not really down to Trump.
Immigration doesn't worry about being deflationary. There's a lot of arguments about the impact of the immigration policy on the U.S. economy, where it's going to show up, first, the labor market, economic growth. Is that something you're focused on?
We've been looking very, very closely at immigration, but the immigration story to us is actually a bit more inflationary, at least in the near term. Maybe in the long term, you start to have that longer-term negative impact on growth, and then it turns to be more deflationary, disinflationary. But certainly in the near term, the impact on wage growth, in some sectors, of course, it's not broad, it's not everywhere, but there'll be certain pockets of the market where you do start to see wage inflation coming through because of that restriction in labour supply. So again, and then you bring in tariffs. To me, if anything, we're worried about the upside to inflation, not really about inflation moving beyond or below the 2% level.
Given all of that, what did you make of the bond market turbulence earlier this week? Was it an opportunity? Did you buy the dip? Kind of, how do you look at that as an event? Because in some ways it seems to have passed very quickly, and a lot of people are now sort of dismissing the fact that we had that it's a crisis. It just seemed like a little bit of a wobble, and we're kind of back to where we were. US rates are still really, at the front end, are still really low. That's great for the funding story over there. The UK is not really affected by what is happening at the 30. Was that a significant event? Can I take it as signal, or is it just noise?
It is not noise. That turbulence, I think, is going to come back. It's going to keep coming back until there is some kind of resolution, either to the upside or to the downside.
What does that look like?
It looks really frightening.
Yeah.
I think the problem for the market and for everyone in this, which is why it keeps occasionally being dismissed and then coming back, is that nobody knows a timeline. You know, typically these bond market crises, they happen when they happen. So we know that there is a problem on the fiscal side. Everyone knows that. And that's not just a US story, it's a global story, which is why you've seen this move up in global bonds across the board. It's really, when does that start to hit?
When do you think?
I think at some point in the next 2 years, there's going to be a moment, there's going to be a crisis. Certainly from our fixed income side, we're really focusing on that short duration because we have got concerns about the long end. So we didn't buy that dip. We're trying to really focus on some of those areas which are less exposed to what we think could be a concerning moment. Now, I'm not going to sound the alarm bells, but it is something that we do need to keep a really close eye on.
Interesting that Ed Yardeni was saying that the US is still the best house in a crumbling neighbourhood. I mean, to your point about all these challenged economies, where do you sit? Do you agree with that line? You want to, if you do need exposure, do you
just move out of the neighbourhood, though? You just leave the neighbourhood and just ignore the whole thing?
No, I do. I mean, look, you know, we know that the US has a problem, but it also has a ton of benefits, the main one being that people are going to continue to buy treasuries because it is that reserve currency. At the same time, the problem for the UK is more immediate. You've got the France issues. The concerns that maybe that we have is that actually you could get some contagion. Let's say that the UK gets a little bit more worrying, you get closer to the budget, maybe the market responds in a really negative way to whatever Rachel Reeves is going to announce. Well, then the global bond story becomes a little bit more concerning.
So the UK could be the centre of a contagion risk, potentially?
Yeah, I think that there's always going to be that risk factor. You know, the UK, to me, is the area which has got the most concerns from a fiscal side because it's very, very difficult for the Chancellor to get out of this mess. I'm not really sure what tax or spending cuts that they can do, tax rises, spending cuts, they can do to really change the narrative. So they are in a difficult spot. Now, of course, the US is quite different, but if you were to see this continued move up in yields, well, I assume that there would be some kind of global impact, whether or not that means crisis, but I think that would probably add pressure to Treasury, certainly.
Structural reform, deregulation. It's going to see where she goes down that road. Seema, great to see you. Always a pleasure. Thank you very much for coming to see us. Seema Shah, Chief Global Strategist at Principal Asset Management. European equities have rolled over a little bit. That's what the Core 6 looks like this morning. A few negatives, a few positives. I think we've priced in the move yesterday afternoon in the States, and now we await what comes this afternoon in the US in the form of payroll data. So that's kind of where we are right now. Interesting to see defense stocks on the front foot, but the real story this morning is in the chip sector. ASML up very, very strongly. Let's talk about all the other details we're watching. Chloe Mellitz here with the details.
Good morning, guys. So let's start with the chip sector. So we've got some positive read across from Broadcom's partnership with OpenAI, and we can see that for ASML and STMicro. And for those two in particular, there's also been two new buy ratings. So ASML was raised to a buy at UBS, and STMicro was also raised to an outperform rating at BNPP Exane. So both of those things are two sets of really good news for that chip sector and those two particular names in that sector. So we have some green movements this morning in that space. Moving on to Ørsted. Ørsted is, as expected, down on the back of that outlook cut. It cut its profit outlook range this morning. This comes after some other bad news with, for example, Trump ordering it to stop work on a big wind project and the capital raise that had already sent the shares plunging earlier this summer. So another set of bad news for Ørsted, and it is down a little bit this morning. Moving on to Temenos. Temenos has replaced its CEO effective immediately last night, and the market is reacting really badly to that. The shares are down 13%. It really raises questions about the stability, the direction of the company moving forward for that banking software provider. Moving on to Hexagon. Hexagon is a Swedish industrial company. It is up this morning on the back of selling its design and engineering unit to a US company called Cadence for 2.7 billion euros. So market reacting quite positively to that for Hexagon. And finally, let's end with Sixt, the rental car company. It is also up. It was initiated at a buy at UBS. It is up 5% on the back of that. UBS mentioned that the US market share gains were a particularly positive note there. So positive this morning for Sixt as well.
Chloe Mellitz from our equity team, thank you very much indeed. Coming up, we're going to look at what is next for the luxury house Armani after billionaire founder Giorgio Armani dies at the age of 91. That is next. This is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Friday morning, good morning. Welcome back. You're watching the opening trade. We are 19 minutes into the equity market session. The Stoxx 600 basically gapped higher first thing this morning, basically filling the gap with what we saw from the United States yesterday. We had to price in that arbitrage. We faded that. So we're basically kind of back to where we were coming out of yesterday's session into today. This as we await the payroll number a little bit later on. There is, though, an interesting story, though, this morning in the chip sector. ASML is definitely one of the strongest performance stocks that we've seen this morning. Broadcom looks like it's having a really solid session overnight. All of the AI tech people had a lovely dinner last night at the White House. Apparently it was raining. Yeah. They had to be inside. They couldn't be outside. Nice new rose garden, I hear.
They wanted to show off, the White House wanted to show off not just their AI plan and their proximity
and the
to the tech bros and girls, but also to the umbrellas and the new patio. I mean, everyone loves a new patio, right? And they have one in the White House. They weren't able to show it off, but they were able to show off Melania and the president alongside, as you can see, some of the key leaders when it comes to driving innovation technology in the US.
Doesn't it sort of hastily convened, doesn't it? Kind of, we've just come inside. It's you're having a barbecue. It's raining outside.
Nice little flowers on the table.
Little?
Come on, guys.
That's not little. That's a lot of flowers.
So they went around the table and essentially pledged their commitments to the US. They thanked President Trump and his administration, and they committed again.
Polite. They were lauding him. They were like, it was being.
This is becoming a trend, isn't it? If you look at the cabinet meetings that they're having, that are remarkable in and of themselves. Slightly different setting, obviously, but they made the commitments. So Apple, for example, $600 billion worth of investments. You've got OpenAI, Sam Altman investing heavily, of course, in Stargate as well. So that is all was part of that dinner as well, and significant. As you say, bringing it back to what's happening in the tech session today, just some of the key names coming through in terms of the gains. ASML's been upgraded. Interestingly, UBS analysts saying that a lot of the bad news and the overhang from the China story for ASML is now priced in, so they've upgraded ASML on the back of that. You're getting some of their competitors and partners, ASM, BE Semiconductor, and ST Micro in France as well, upgraded, or at least prices up, stocks up, partly linked to the upgrade you would assume around ASML. And then there's a Broadcom story as well.
Well, yeah, you have to add to that there was maybe one negative point out of that Trump meeting with tech leaders yesterday, in that Trump warned of more pain ahead for the chip industry during the dinner at the White House with top executives, especially when it comes to tariffs.
Chips and semiconductors, and we'll be putting tariffs on companies that aren't coming in. We'll be putting a tariff very shortly. You probably are hearing we'll be putting a fairly substantial tariff on, not that high, but fairly substantial tariff.
He did note when he was speaking about tariffs that Tim Cook is in pretty good shape, kind of foreshadowing what we've heard before, that Apple is going to get a big carve out in any of these tariff regulations.
So, but they're starting to produce, Tim Cook's starting to produce a lot of phones in India, isn't he? Those cause a problem going into, but maybe they don't go into the United States.
And this was a strategy that's built out prior to Trump coming back into office for the second time, which we need to reduce our exposure, not just on the consumer in China, but also the supply chain in China. And so we'll start to build out factories and processing units in the Indian market, and we'll try to tap into that strong consumer as well in India. And that is starting to pay off, at least in terms of the numbers that Bloomberg has today, in terms of revenues rising about 13%. So they're getting about $9 billion. Now, in the scale of things, that's pretty small, but it's the trajectory of growth that's been very impressive in India for Apple, but at a time, of course, when we have these 50% tariffs on India. Apple is not impacted by that because they do have this carve-out, to your point, Val.
I feel I should have worn an Armani tie this morning. I didn't. It's a mistake. I wish I had.
We would like to see that, Guy.
Yeah.
You'd be
maybe
you could be a better model for the Armani tie
on Monday.
than Guy Johnson.
Anyway, the great man has died. Giorgio Armani dies at 91. He kept his empire together for decades after decades. Never had some sort of succession in place. He kept the helms of this business, which was absolutely amazing. Independent, it was always independent. Like Italian icons, Gucci and Fendi, they were snapped up by other names, which is so interesting given how Armani basically kept everything that he had together. The future of the empire that he created now in the hands of family and close associates. Flavio Rontandi joins us now from Rome to talk about all of this. Armani is just this amazing Italian character, this amazing Italian leader. He told Bloomberg News last year he wouldn't roll out an IPO or a sale to a larger group once he was gone, but he was waiting for that. Not he was waiting, but everybody was kind of knew that it wouldn't happen until that moment happened. What happens now? What's the company saying about what the future of this business looks like?
Good morning also. What I got yesterday, for example, from the spokesperson of Mr. Armani was that now the future is somehow in the hands of the family, the heirs, and the Lord, who has been his partner for years, his right arm for years. But this is, of course, a kind of a generic, if you want, answer. We don't know in details what is really going to happen. We know that there is a succession plan pretty precise in place with some shares, some part of the company to be given to some members of the family, nieces and nephew, and again the partners. But we don't know exactly the percentage. But also the main question is what happened next, because yes, there will be this legacy. This will probably be read next week, very soon, and we will have a better idea. But really, the big question is what will happen next, because as you mentioned, Mr. Armani last year in an interview with us told us for the first time that he was open to the possibility of an IPO, a possible sale of a stake, and he didn't mention groups, he didn't mention potential buyers, but the first time said this is something that we cannot rule out completely, because we have to adapt with the times, we adapt with the changes that we are facing, and we have to keep the company in mind, what is really good for the company in mind. That was definitely is a take, and we'll see what's going to happen. Of course, we had many speculation about possible buyers abroad, funds, but we don't know for sure yet.
Okay, uncertainty in terms of what happens to this business going forward. Bloomberg reporter Flavio Rotondi, at a time, of course, where the luxury sector broadly has been challenged by the slowdown, particularly in the consumer over in China. Coming up, we will talk tariffs, labour supply, the Fed, and much more with Freya Beamish, Chief Economist at TS Lombard. That is next. This is Bloomberg.
You've said 25% last year, I believe, of Google's code is AI generated. You have over 180,000 employees right now. Is it half that in the future?
I expect we will grow from our current engineering base even into next year, right? Because it allows us to do more, right? I think the opportunity space is also increasing. I just view this as making engineers dramatically more productive getting a lot of the mundane aspects out of what they do, allowing them to spend on higher value-added tasks. But that means it's an accelerator. People will be able to do more, which means maybe we'll create new products, and hence we will need more people. At least in the near term, to me, it looks like we will expand engineering velocity, and that doesn't mean we're constrained in what we will do. We'll end up doing more as a company as well.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
This is the opening trade. We are 30 minutes into today's session. I don't want to give too much credit to Guy Johnson, but when he pointed out that his excitement, the lack of excitement around the European future story was baked in, well, I have to give it to him because, look, we paired some of the earlier gains. We're up just 0.1%. We're essentially flat on the DAX. We're flat on the CAC run, and the FTSE 100 is up just 0.1%. The S&P, of course, 500 closed in fresh record highs yesterday. It really is all about that non-farm payrolls, and you're not going to be putting big bets on until you get that number through. 1:30 p.m. UK time. Guy, you called it on the futures.
Yeah, it's going to be a game of two halves though today, isn't it? It's going to be a quiet first half and potentially quite a busy second half. 1:30 p.m. is when the US data drops. We'll wait for that moment, and potentially we're going to get some volatility. It's really interesting. On the day, volatility is super low going into this number a little bit later on. Stock 600 members up, down, well, actually tells you that actually the bigger names are maybe on the downside today. You got 196 down, you got 388 to the upside. Tech is on the front foot. Volume is a little light, but volume has been feeling a little light for a few days now. Kind of August, yeah, I can accept that. Beginning of September, maybe we need to get things going a little bit. One area that we have focused on this week has been the gold story. It continues to power ahead. One of the biggest beneficiaries of that is Fresnillo. The mining stock is up again today, another fresh 52-week high. The stock is now up over 300% on a 52-week basis, and this stock continues to be one of the ways that you trade that gold narrative. If you don't want to buy something shiny and heavy right now, you can buy maybe some of this, but the stock hitting a 52-week high once again this morning going into the payroll data. Val, what do you got?
Here's what else you need to know this morning. Broadcom is helping OpenAI design and produce an AI accelerator from 2026, jumping into the lucrative sphere dominated by NVIDIA. Sources say the two firms plan to ship the first chips in that lineup starting next year. German factory orders unexpectedly dropped by 2.9% from the previous month, driven by declines in large-scale orders. The weak report underscores the challenges faced by Europe's biggest economy as it tries to leave behind a prolonged downturn while grappling with higher U.S. tariffs and Russia's war in Ukraine. And finally, traders today bracing for today's unemployment report, which stands to solidify views on Fed policy and determine the near-term trajectory of interest rates. The consensus forecast for non-farm payrolls stands at 75,000 for August, which would mark the fourth straight month of job growth below 100,000. The unemployment rate is expected to tick up to 4.3%, the highest level since 2021. Tom?
And the drum roll leading up to today's jobless print, the non-farm payroll print, has been a softer labour market. Whether you look at JOLTS or, of course, jobless claims, the Challenger report, interestingly, as well, hiring plans falling to the weakest for any August on record. To your point, 75,000, Val, is what is expected. That is the median estimate, of course. And the question mark is, to what extent above or below that does that become either a problem or a catalyst for the markets when we think about pricing in a Fed for September the 17th?
Yeah, and that weak jobs data that you've mentioned, that the jobs data we had gotten so far has really led this week to become all about a bond rally rather than a bond rout. If you look at even the terminal rate in the front end of what we've priced in for the Fed, lowest for the cycle, and those two-year yields today are hovering at year-to-date lows.
Has the data over the last couple of months there been a head fake? You always get this concern that once you start to see the labour market rolling over, it accelerates to the downside. But if you take a look at the ISM data yesterday, the US economy looks like it's in okay shape. And maybe actually it was a head fake and people start hiring again, and actually the labour market starts to pick up again from here, which means that we maybe refocus our attention back on what is happening with the inflation picture. Anyway, it's going to be interesting to see what the number today is. The whisper number is 75k. The survey number is 75k. Interesting to see those two things aligned as well. Freya Beamish, Chief Economist at TS Lombard, joining us around the table. Good morning.
Good morning.
Is the labour market rolling over in the States?
I think what you just said is very interesting in the lead up there, in the sense that this is more like a sort of a freak weather event than data, the weak data over the course of the summer and potentially still today, given the ADP was at 54. It's more like there's been a big shock, there's been a lot of uncertainty, and companies are sort of on hold rather than us being able to sort of turn to these labour market data and say that is an indication of reflexivity kicking in and we're about to sort of go towards recession or some form of slowdown. It's more like a sort of a liberation day, in a sense, was more like a sort of a freak weather event.
So Chris Waller saying we need therefore to cut quite a few times in order to make sure that we don't get kind of the traditional acceleration in downside moves in the labour market. That's not the right way of looking at it.
I think the risk there is that you start to get a recovery as firms start to feel a little bit more certain. The jobs data and the inflation data go hand in hand. So if you get more certainty and companies starting to hire again, then you'll also see a pickup in the pass-through rate of tariffs to inflation. And so those two things are going to start going in the hawkish direction at the same time. So you could end up with the Fed sort of overreacting to the weakness in the labour market, very focused on the labour market over the summer and at Jackson Hole, and maybe kind of cutting too much. And then the big question is going to be more on the equity side, how much of this is sort of like boom-led, demand-led inflation, and how much of it is more negative supply shock inflation because that is a real serious concern. So it's more obvious for the bond market that would turn out to be, oh gosh, actually terminal rate is too low for an independent Fed at least. We've got a little bit ahead of ourselves. Whereas for the equity market, it'll be more open to question if they do get ahead and kind of cut, whether this is like an inflationary boom or whether it's just supply-driven, some negative supply-driven inflation.
Yeah, Freya, to that point, you noted in your note that you think that August was peak dovishness for the Federal Reserve. But it does get complicated if you do have Trump picks being a majority of those Fed governor seat next year. I mean, that could be something that could really hamper this view that you have that the labor market's going to reaccelerate, inflation's going to reaccelerate, and the Fed's going to have to pivot. How are you calculating that in right now?
So I think for the next into December, so say we do get ahead and we get the cut in September, and they've signaled pretty clearly that that's going to happen. We'd have to see a lot to change that at this moment in time. By the time we get to December, though, if the labour market has started to recover, and we should talk about what's the bar for recovery, because it's lower than it was, then come September, I think the calculus is still on sort of like independent, we're doing what we're trying to do to actually get to inflation. Looking longer term, there's a very serious encroachment here, attempted encroachment onto the independence of the Fed. Now, the long end of the curve cares less about that than the short end of the curve, so that's one way that we can play it. If they do end up cutting, going closer to that, what is currently seen as the terminal rate, which is quite low in my opinion, then that is just going to show up in greater inflation, and that'll show up at the long end of the curve. If we get to a situation where there's even greater encroachment on independence and there's some effect to control the long end of the curve, then it just shows up in the dollar, and hopefully they don't go further than that.
Freya, you're talking about the reacceleration or recovery in the U.S. job market, but surely there's going to be some out there that will just argue, well, the run rate for NFP is just way lower because of the immigration policy. How would you, I guess, in your mind, a recovery looks like what on the NFP?
Absolutely, and then this is very different in terms of what an independent Fed would see as a recovery versus what the sort of equity market bulls might be looking for as a recovery. 100 was the reference point that everyone that you've used in your introduction that everyone uses, but with demographic decline and some of the papers that were coming through at Jackson Hole with immigration policy, NFP break-evens are really coming down quite significantly. So 54 in an ADP, that feels weak, but compared with what is the new break-even going to actually be in terms of like how hot how high is actually a hot number?
Yeah. What's the number on NFP?
So today?
Yeah, no. What's the break even? What's the
break even? So I would say it's probably come down to at most 80. If we think about ICE detentions getting back to 1,200 per day, which was the June peak, I would pull that NFP break even rate down even further into the 60s. So 54 is actually not that weak in that context.
What does all of that mean for wage dynamics in the US?
Yeah, good question. So we've got potentially a labour market that is more easy to overheat, and then we've got a level shift in prices certainly, which is what everyone is focusing on as a result of the tariffs. But the secondary effect of the tariffs is probably not just the level shift in prices, but also in the rate of inflation, in the sense that tighter labour markets easier to overheat, and tariffs are sort of cordoning off domestic labour market bargaining power from the rest of the world. So domestic labour market tightness is more likely to feed into wage growth than it was over the course of the past several decades, going back to the 90s. And then on top of that, the marginal unit of labour is going to be the domestic unit labour costs, and therefore the relationship between unit labour cost growth and inflation has to go back to a 90s type of relationship, where the margins are actually paying more attention to the domestic labour cost than they were to the offshore.
So just projecting out to 2026, then, if we do get a less independent Fed and we get the reforms and the changes that President Trump is pushing for, and they don't walk back in terms of some of the market pricing, we get 6, 5, even 4, and then we have a reheated labour market. What does that US economy look like in 2026?
So this is a really important pivot in terms of markets at the moment are very focused on the jobs numbers. I think none of the Fed independent stuff really matters if you're in an environment where, oh gosh, there's a sort of a recession risk, or there's a slowdown. Where it starts to matter and where the attack on institutions starts to get priced into markets is if this inflation stuff starts to come through, because then you need the Fed to be independent. So this is an economy where we are going to see, I think, more supply side driven inflation, negative supply shock driven inflation. That's going to deteriorate the correlation between bonds and equities. There's going to be less negativity in that correlation there. That's going to make it more difficult for the government to issue debt, because actually in that environment, when you have a negative supply shock driven inflation system, there is a positive correlation between bond issuance and yields. And so a lot of things happen.
That's a this year story?
That's a sort of a 12-month story. I think we keep on seeing instances of those correlations changing when there's big shocks. When we think there's going to be a big tariff shock, then you see the positive bond equity correlation and dollar selling off. When we see those types of shocks, there's been a few event studies now where we get a little bit of a feeling of that. But we can almost go back to the 80s and think about the situation in reverse. It took a long time for term premium to get priced down in the 80s after the 70s. Now we're sort of almost in the reverse situation to that, where there's a good reason to expect term premium really should be higher, which means that bond investors are not really being compensated for the risk at this stage.
On that note, can I just shift the spotlight to Europe for a moment? Germany. There was this argument for most of this year that Germany is about to spend a load of money, the economy is going to take off, we're going to see some more positive data. I'm not seeing that data yet. I'm looking at the factory orders this morning. I'm saying unemployment's starting to... Am I just too early in in the view that the German economy is about to take off, or should I be concerned about the fact that unemployment's beginning to tick higher and the chemicals industry doesn't look good and the factory data doesn't look particularly solid?
Yeah, I think we're still in the old regime, really. So a lot of what we've talked about with the US, the spillover of that is that the German fiscal house is being put in order. I don't think we should ever have expected that to have come through before Q4.
Right.
We're now, to be honest, pushing that back into next year in terms of when the fiscal is actually going to hit the economy. And I think that turns the European story into a benign form of reflation, a demand-led form of reflation. So in the US, we've got greater risk of negative supply shock-driven inflation, bad for bonds and equities in
So I can ignore
Europe.
the data for now. It's coming. It's going to get better.
It's going to get better.
Okay.
Okay, two different types of inflation as well, Europe versus the US. Freya Beamish, Chief Economist at TS Lombard, brilliant breakdown of what to expect as well on a day when we lead up, of course, to the jobs data out of the US. Coming up to UK politics, Nigel Farage takes centre stage, working to keep his party in check as the Populist Party Reform UK kicks off its biggest conference yet. That's happening today. We're going to discuss all of that next. And this is Bloomberg.
Single best investment opportunity you see in the world, regardless of industry or geography. Why? And again, how are you making it available to your clients?
I think there's no question AI is going to impact everything we do. The opportunity to take great companies and use AI is going to transform. Also, the issue of jobs. What do we do with jobs? Because there's no question, you look at things that are customer service oriented, and the AI is so much more efficient. As we look at across all these different opportunities, what we really like is data centers in the U.S. And, the one thing that we know is that AI is just going to create this enormous demand for data and this even growing opportunity for cloud computing. So for us, owning data centers for 20, 30, 50 years, we're going to have a limitation on power in the U.S. There's no question over the next 20 years, the technology will change for chips. It'll become more competitive, and NVIDIA may not be the only major provider. So I think you're going to have a big technology refresh over the next 20 years. But the one thing we know is you're going to need data centers, you're going to need power, you're going to need cooling to support all this growth in the cloud. So we look at them as long-term bonds.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
Welcome back to the opening trade. We're 47 minutes into today's equity session here in Europe, and we are at session highs when it comes to the Euro Stoxx 600, up 0.4%. Also adding to record highs as well over on Wall Street. S&P 500 futures up 0.2%.
Okay, to UK politics now. Nigel Farage is seizing the spotlight, not for the first time, as Reform UK kicks off its biggest conference yet in Birmingham, fresh from meeting Donald Trump in Washington. The Populist Party's leader is riding high in the polls here domestically. He faces a test of keeping hard right supporters in check while appealing to mainstream voters. For more, we are joined by our London Bureau Chief, Ruth David, and what to expect, what to watch for from the conference from Reform, and whether or not there's going to be a big business lobby there or not. Executives in attendance, the FT suggests that maybe not from their reporting. What are you going to be watching for? I mean, Nigel Farage has just been sparring with lawmakers in the US. Now he's here with his own summit.
Sparring with lawmakers, but that photograph of him standing with President Trump,
yeah.
I mean, a photo speaks more than all of the reams of coverage, right? To have that kind of backing and to have that kind of support globally. We saw Tony Blair going to the US. We're seeing Nigel Farage. And the question is, where is Keir Starmer? And I know Donald Trump is coming to the UK later. But it definitely seems to be like Farage is riding on a high. And it's interesting because, you know, a former Conservative minister once said that the Conservatives did not lose the last election. The Conservatives lost the last election. Labour didn't win it. And you have to think that right now when you see what's happening with the Labour Party. So everybody's saying it doesn't seem like Reform has a lot of key policies in place, but there's so much discontent with the way Labour is running this country that people are flocking to Reform. Look at the number of members, 239,000 for a party that was set up in 2018.
Yeah.
12,000 descending.
Is Reform now the opposition party? Starmer's treating Reform like the opposition party. He's not treating the Conservatives like the opposition party. He's treating Reform and tailoring policy and worrying about kind of what Reform is doing and thinking about how he responds to it. Is Nigel Farage the leader of the opposition?
Well, if you would ask the Conservative Party, Jacob Rees-Mogg, Nadine Dorries, there's this steady stream of Conservative Party members and ex-members that are now leaving to join Reform and that are being highlighted. And it definitely feels like there is that momentum. I think the big question is, how does Farage translate that into them being seen as the effective party that can set policy and that also is not far right? Farage seems to keep making the case that his is not the far right party. But if you look at Zia Yusuf and the kind of abuse that he has been getting, you look at the fact that a member of the party had said, let's ban the burqa. You know, there are a lot of these far right leanings. And the question is the UK electorate ready for such a leader?
Judging by the polling numbers at the moment, that's an interesting question to ask. And the data sending you a pretty clear answer. Ruth, thank you very much indeed. Ruth David, our London Bureau Chief. Let's talk about French politics now. French Prime Minister François Bayrou says he doesn't regret calling a confidence vote, putting his government on the line as France is burdened with debt, quote. This as the French President Emmanuel Macron says he will seek to avoid a snap election if Bayrou loses. Jean Dabad of Bloomberg Economics has been looking at the likely economic fallout that we could potentially be seeing next week. Good morning. What are the different scenarios for France over the next few days? We've got this kind of series of events that could take us to another prime minister, another election, a presidential election. What are they telling you about the level of uncertainty in France at the moment?
Good morning. So, yes, absolutely. I mean, the baseline is that France is facing a new political crisis. In our main scenario, we expect François Bayrou's government to collapse on Monday afternoon after the confidence vote at Parliament. And then we would expect President Macron to appoint a new prime minister that will try to lean toward the center-left of the political spectrum, and whose main objective will be to reach a deal with the current coalition and with the Republicans to pass a budget. So that would be its main objective. But all in all, the political uncertainty has risen a lot, and that's something pretty striking if you look at our new index published by Bloomberg Economics that has skyrocketed over the past week. So it's really like a main trend in France that political uncertainty is really high, and we are facing a new political crisis. So as I said, our main scenario is for the government to collapse, President Macron to appoint a new prime minister, but our main risk is for President Macron to call snap elections. So that would be a really downside risk to the political situation in France, because it would lead to another fragmented parliament, and where probably the far right would have not a majority, but would be in a position to lead a new minority government.
John, at least when it comes to the markets, the main concern is that this political crisis could turn into a debt crisis and impact the bond market. What's your view on that?
So far, we are not really concerned regarding the bond market. In our view, it's mainly a political crisis, not a debt crisis yet, nor an economic crisis yet. If you look at the spread of French bonds against German bonds, it has widened by around 10 basis points over the past week, which is in a way pretty moderate, especially if you compare that widening to what happened last year with when Prime Minister Barnier was ousted by no confidence vote in December, when the spread widened a bit more. So, in our view, the risks are contained. It doesn't mean that there is no fiscal risk in France. I mean, if you look at debt servicing costs for France, it will increase a lot in the coming years. And that's the reason why a substantial fiscal consolidation package is required for France. And that's exactly one of the reasons why the current government will fall, basically. It's to pass that important and ambitious consolidation package. So in few words, no specific fiscal risk on the short term, but some fiscal issues and major ones over the medium term.
How do you fit, Jean, how do you fit the French story, the debt challenges, of course, the deficit, 5.4% projected for this year, and what we've seen in terms of the OATs into the broader global context?
So absolutely, I mean, France is a massive issuer of long-term bonds, especially in the euro area. So that's one of the reasons why it is interesting to look at the sell-off on the 30-year point of the curve. So that's really important for France as well. But it's fair to say that recently the DMO has shifted its issuances toward shorter part of the curve, like the 10-year points, for example, so that there is no specific risk from that sell-off. I mean, at least from a fiscal perspective, there is no specific risk from that sell-off in the 30-year points. I mean, we can point out that it's also driven by global factors as well, like higher issuances globally, central banks doing QT, like some shifts in investors' preferences. If you think at Dutch pension funds, for example, that's pretty striking, but also to some global seasonality, to some global technical factors as well. So it's not only related to France, and it's not really like a fiscal issue for France, at least on the short term, because France is mainly focusing on issuing debt at shorter maturities like 10-year points. So it's not a big issue for the moment. It could become an issue on the financial stability, from a financial stability perspective.
Okay, Jean Dalbal, economist at Bloomberg Economics, thank you very much indeed. European markets, they've been pretty choppy so far in the session, 55 minutes into your Friday session, currently up 0.4%, as we, of course, look ahead to the big data print of the week, which is non-farm payrolls, expected 75,000, 4.3% potentially on unemployment.
Yeah, and attention on the revisions. You know, last time there was such a steep downward revisions on this payroll number. I thought it was interesting that our previous guest, Freya from TS Lombard, was talking about a run rate of 60K. That it being it for the U.S. economy if these deportations, if this immigration policy stays as strict as it has been earlier.
So should the Fed be cutting if we've got a 60K print?
I mean, in that mind, that's a hot print today, right? I think this is what the market's going to have to deal with. What is the bar for a hot print if the run rate for the U.S. economy, those estimates for what that break-even rate is all over the place?
It makes it really hard to call. And it certainly makes it harder for a 50. If the run rate is 60, to get a 50 basis point cut, do you have to have a negative print?
Negative, yeah, decently.
And this is a Freya Beamish who expects to see a tighter labour market in the second half and into 2026, and possibly higher wages as well.
I would argue that the NFP print is like a sporting event.
I like that segue.
I
for
think
traders.
That's how we should be thinking about this. But you've got the NFL.
Yeah.
Second game.
Alcaraz and Djokovic.
That's coming up
shortly
over the
after
weekend.
non-farm payrolls.
Yeah, isn't Travis Kelce going down
Taylor
to
Swift's fiance in Brazil?
In Brazil.
Do you think she'll be there?
I don't know. The Italian Grand Prix is coming up this weekend.
Guy's still halfway through that podcast.
Well, precisely, yeah. Still enjoying it. New York Fashion Week. New York Fashion Week as well, coming up. Plus also the tennis in New York as well. What a weekend in New York. Anyway, great weekend coming up. NFPs are first. We'll see you Monday. The Pulse is next. This is Bloomberg.
you missed it on Bloomberg Open Interest.
When we look at our portfolio, we see an IPO pipeline that's the biggest since it's been in 2021.
In M&A and IPOs, we've actually had close to record performances in that space. We're going to have an interesting year.
We're having a lot more conversations around putting dates on calendars. I think we could see a very active second half of the year.
Don't miss Open Interest live weekdays.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hardern in Alberta, Canada, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onin, only on Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Jobs day in the USA. Stocks rise as traders look for a rate cut confirmation after more signs of a cooling U.S. labor market. And Stephen Myron says that he's committed to central bank independence. President Trump's pick to fill a vacancy on the Fed's Board of Governors is grilled in a confirmation hearing. Plus, taking on NVIDIA. Broadcom said to be helping OpenAI to design and produce AI chips. Well, checking in on these markets this Friday morning, and we have stocks on the front foot heading into payrolls. For a third straight day, we have European stocks higher. But that could all change later today when we get that payrolls number. Futures higher stateside as well. They already hit a record on the S&P yesterday off that trio of jobs data we already got. The 2-year yield at its lowest so far this year, 358.54 right now. And Brent looking for a weekly decline as we go towards that OPEC Plus meeting. Do we get another production hike? We're braced for that in these markets. Now let's dive into what's happening across the European continent. You've got outperformance in the Netherlands on the AEX, up 0.5% right now. This after UBS upgraded ASML, but also a bit of strength for the FTSE 250, the domestically focused index. Nice to have a bit of that after Tuesday's horrible session. The Pulse starts now.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Lizzie Burden in London for Francine Lacqua. Now let's check in on these pre-market movers, shall we? We have moves for Broadcom after Bloomberg learned that Broadcom's helping OpenAI design and produce an AI accelerator chip from next year. They're getting into this lucrative sphere that's been dominated, of course, by NVIDIA. And the chip maker also reporting third quarter results that beat expectations on AI semiconductor revenue. The CEO pointing to a strong AI outlook. So you can see Broadcom shares up 6% there, but disappointment for Lululemon. Look at that, down nearly 17%. They slashed their output, disappointing investors for a third straight quarter as they really struggled to meet the high expectations of the company. and to balance tariff expenses. Now, this Wall Street stock rally is extended into Asia as further signs of a cooling labour market have reinforced those bets that the Fed's going to cut rates later this month. The Fed's John Williams says that he expects rates will come down eventually.
Looking ahead, if progress on our dual mandate goals continues as in my baseline forecast, I anticipate it will become appropriate to move interest rates towards a more neutral stance over time.
Well, joining me now is Emmanuel Go, Head of European Equity Strategy over at Barclays. Happy September to you, Emmanuel.
Thank you, Lizzie.
It's usually the time of year when we're cautious when it comes to equities, but you, I see, are telling everyone to buy the dip. Why?
Yeah, look, we still believe the growth policy trade-off is decent, right? So I think in the US, the direction of travel is very clear. You know, the Fed is going to cut rate. I know there's a lot of concern about their independence, but we think they have good reason to cut rate. The job market is softening, but not enough yet to really revive this kind of recession worries. It's not too hot, not too cold data thing is keeping the Goldilocks narrative on track for now.
Well, yeah, that's what I want to ask you, because why is bad news necessarily good news? Is the prospect of Fed cuts enough to, you know, grow the economy and to juice this market?
I mean, this is obviously the narrative for now. So there's a big number coming out today with payrolls. I think we need either very hot or very cold data to derail this Goldilocks narrative. At some point, bad will be bad, right? So I think we need to be careful what we are wishing for. We need to see some softening in the data for the Fed to cut rates. They won't be cutting rate if growth is flying. But at some point, if the data is really slowing, I think the market will start to question whether the Fed isn't too late, right? So far, we think there is a window for the Fed to cut rate preemptively and reassure the market on their intention to prevent a meaningful shock to the economy.
But you touched on Fed independence. When you think about the source of that jobs data, the BLS, obviously the president fired its boss. So how much credibility does the payrolls data actually have, especially as we had all those revisions last time?
Look, it has to be put in a context of other indicators, I think, from different sources, private sources, showing that labor market is slowing, right? So we got ADP data yesterday, jobless claims showing some increase as well. ISM survey were pointing to a slower market condition as well in employment. So look, across the board, I think the signs are pretty clear that, there is some degree of softening in the labor market. But of course, the market might be a bit more concerned about the quality of the data. But I think for now, all the indicators are pointing to a fair amount of softening in the job market.
But of course, it's not all about the macro. Are you not worried about valuations?
Look, there are a lot of things to worry about. I would say I would put valuation in the context of two things. Firstly, real rates are coming down, which is obviously a support to valuation. Secondly, earnings are still doing the heavy lifting. Earnings are growing. S&P EPS beat estimate by $5 in Q2, and we are seeing earnings revision across the board in the US, but also in Europe now, starting to inflect higher, right? So I think that's why we are seeing this pretty decent growth policy setup where policy is getting a bit more supportive with the Fed likely to cut rate. At the same time, growth and earnings are holding up, which is a pretty decent setup for the equity market.
Okay, so everything's perfect for you so far, Emmanuel. But when we look at big tech specifically, you had those underwhelming earnings from NVIDIA, as some would put it, uninspiring, shall we say. Then you've got this renewed threat from DeepSeek. It's got its AI agent getting ready for the end of the year. How much of a threat does that pose to the Mag 7, and how much does it make you want to look elsewhere to China?
Look, I think there are issues that this concentration might, put the broader market at risk if there are no alternative to AI and Mag 7. So the threat, as you said, were maybe a bit of fatigue with AI, high valuation, very crowding positioning, plus this competition from Chinese AI, right? So this is something which might prompt a bit of unwind of de-risking on the space. I would say, luckily, there's a bit more, I think, opportunity to invest elsewhere and play a bit of rotation into some of the laggards. That's why I think the Fed put is very important, because if the Fed is in a position to cut interest rate and to prevent a hard landing of the economy, we might see some of the lagging part of the equity market, the S&P 493 basically, starting to catch a bit. And we've seen basically in the last 4 or 5 weeks already, small caps, for example, performing better after underperforming for many, many years. So I think this easing in financial condition, while growth is still decent, is helping a bit of broadening out of big tech and some, rotation into some of the maybe shorter cycle type of stocks.
And how far do you take that broadening out then? Do you go even into Europe as well?
Look, I think Europe has a different narrative. Europe has been the kind of shiny market in the first half of the year. I think it was just a bit of luck that people were keen to sell tech at the start of the year. There was this DeepSeek moment, and investors were rotating into tech-light indices, which did benefit Europe. What we saw over the last 6 months already is Europe losing some of this Q1 and outperformance, largely because of concern about tariff, global trade, global demand, and the strength in the currency. So now we are back to a point where Europe has mostly lost their outperformance for the year. Two things. Obviously, you have the domestic concern about politics. France has a number of event risks next week. People are quite worried about the execution on the German stimulus as well. And we've seen some issue with earnings being cut meaningfully on the back of this euro appreciation.
But on France, you mentioned the political risk. The CAC's so internationally exposed. Is it really going to have that much of an effect?
Well, I think that's what I was about to say, that if, for Europe, somewhat counterintuitively, even though we may have some domestic issues, as long as we see some green shot in US consumer, in Chinese data, and euro start to stabilize, we might start to see a little bit of catch-up from some of these cyclical exporters. And this is basically in line with our recommendation. We've been reducing our domestic exposure to Europe. We cut, for example, utilities earlier this week to add back to some of these global cycle plays like industrials or tech after a pretty weak performance in the last few months.
And I see that you overweight the FTSE 100, right? Why bother with equities at all, Emmanuel, when you've got long and gilt yields yielding, let me have a look, today, 10-year yield, 4.7%?
Look, bad news for the UK are usually good news for the FTSE 100, which is a very internationally geared index. So, yes, I think there's going to be a lot of noise into the 26th of November budget. It's hard to see anything good happening because the Chancellor has to keep the bond market happy, which means that they would have to come up with some degree of fiscal tightening, in my view, which might put pressure on the more domestic part of the UK equity market, who are nervous, quite bearish on the FTSE 250, but the FTSE 100 is much more leveraged to global demand and has this tailwind from potentially weaker currencies. So that's why we think FTSE 100 as a more defensive and export-driven index can perform even with the domestic noise constraining the mood on the UK markets.
Okay, well, Emmanuel, great to have you with us. We've got the FTSE 100 up 0.25% as things stand. But good to see you. The head of European equity strategy over at Barclays, Emmanuel Co. Now, some breaking lines on the terminal out of China. China is going to adopt anti-dumping measures on pork that's coming from the European Union. They say that they're going to collect up to 62.4% deposits on EU pork, and China issuing these preliminary results on the EU pork probe. So this is the latest on the trade story. 62.4% is the red head, the number of the levy that they're going to be charging. But let's get back to the Fed story. Stephen Miron, President Donald Trump's pick for the Fed's Board of Governors, has pushed back against Democratic concerns that he would do Trump's bidding at the central bank. Democrats also raised concerns that Miron's decision to stay on the White House payroll, albeit unpaid, while also serving at the Federal Reserve, could compromise his independence.
Look, the president nominated me because I have policy views that I suppose that he liked. If I'm confirmed to this role, I will act independently, as the Federal Reserve always does, based on my own personal analysis of economic data, my own personal analysis of the effects of economic policies upon the economy, and act based on my judgment of the best economic policy possible.
Let's get analysis now with Bloomberg's Ros Matheson. Ros, we watched that. We knew who was going to defend Fed independence. But what we want to know is Stephen Miron going to be confirmed for the September meeting? And is he going to be pushing for a half-point cut?
Well, the second part is kind of the really interesting question, because it does seem as though he's going to get through. I mean, none of the Republicans on this committee seemingly wanted, raise the hackles of Donald Trump by publicly opposing this nomination. And of course, he was going to get grilled by the Democrats on it. I mean, there are signs of unease amongst some of the Republicans about this, but in the aftermath, there was no indication that they're going to try and block that. And the idea is to fast track it through. So in fact, he can be part of the September rate decision. And the question is, does he try and push for 50 basis points? If so, I mean, the US Treasury Secretary Scott Bessent has been quite vocal in saying that the Fed should consider 50 basis points at this meeting. Does he sort of tip his hat to that in a minute. But again, he would be one voice still, you know, in the whole cacophony of Fed voices on this decision. And for the Fed, going 50 basis points would be a big move and risk the Fed, you know, being accused then of responding to politics versus responding to pure economics. I mean, a rate cut is on the table at this meeting, especially, again, depending what we see with payrolls today. But there's a big difference between 25 and 50, and most people in the Fed clearly know that.
Well, the other bit of drama that's happening at the Fed, of course, is around Lisa Cook, the other Fed governor, and the Justice Department actually stepping up and launching a criminal investigation. So are we going to see her on the Fed board when it comes to the September meeting?
Well, for now, the most important thing is the legal case against her. The DOJ has opened this criminal probe, which was possibly not that surprising. It was heading in that direction. The question is, how quickly does that move alongside the legal case that we've got going on? And we know, of course, that we had the U.S. administration filing further details yesterday in their claim against her. But the judge in that case hasn't given a sense of when they plan to rule. It could be next week, whether this is like basically on that idea of the injunction and where to go from there, or do they punt it even closer to the Fed decision? But in theory, she's able to stay in place until at least that ruling happens. And so if it comes next week, you know, that could have ramifications for her, or does it get dragged on ever closer to the Fed meeting?
Okay, Bloomberg's Rosalind Matheson, we thank you so much. Well, we also have breaking lines out of Ørsted. We were talking about legal issues around the US government, and Ørsted, of course, suing the US government as it tries to revive the building of its offshore wind farm in New England. We have a redhead that Ørsted shareholders have approved the rights issue after a profit warning. We'll get more on that in just a moment, as well as we'll ask the question whether Europe has become any more competitive after a year after the Draghi report. We'll get your assessment next. This is Bloomberg.
up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
So, Ørsted shares up 0.8% after shareholders voted to support a crucial 60 billion Danish kroner rights offering just after the company issued a fresh profit warning on Friday. Now, the Danish wind developer is asking for almost 3/4 of its market value in new capital after all the turmoil that, of course, has been caused by President Trump's efforts to halt the development of their offshore wind farms. So the stock on the front foot this morning. Let's stay in Europe and turn to France, where Prime Minister François Bayrou says that he doesn't regret calling a confidence vote, putting his government on the line, as France is burdened with debt, in his words, and the political parties, as he says, must each take responsibility. Now, in this interview on French TV, he said that he was, quote, putting the future of the government on the table. This as French President Emmanuel Macron says that he'll seek to avoid a snap election if Bayrou loses. We can speak now to Jean Dalbar, who is economist for Bloomberg Economics, and he's been looking into all of the possible likely fallouts for us. So, hey again, Jean. Just walk us through the different scenarios for France and your new uncertainty index, what it says about what could happen.
Sure, absolutely. No, France is facing a new political crisis, and it is particularly striking if you look at our new economic policy uncertainty index that has skyrocketed over the past week. So it pretty much illustrates the intensity of the political crisis France is facing. And indeed, we expect the government to collapse next week during a confidence vote at Parliament on Monday. And then we would expect President Macron to appoint a new prime minister that would lean toward the center-left in a way to find a deal with the current coalition on the budget. So that's our main scenario. The main risk would be for President Macron to instead call for snap elections, which would lead to, in our view, a new fragmented parliament and probably a new government led by the far-right party.
Okay, Jean, thank you so much. Jean Dalbar from Bloomberg Economics with that look ahead to Monday's confidence vote. Now, it's almost a year since former ECB President Mario Draghi issued an influential report on European competitiveness. It provided detailed recommendations, as you'll remember, to the European Commission on creating a capital markets union and funding innovation, funding growth. So what's changed 12 months later? Joining us now for an assessment is Sander Tordois, Chief Economist at the Centre for European Reform. Sander, good morning. It's back to school season, so it's time to mark Europe's homework. What grade would you give them on the assignment from Draghi?
I think, fundamentally his quite dire diagnosis last year has only been brought home more this year. Europe's energy problems are brought to the fore more by the energy needs of AI, where Europe was already lagging. The kind of economic coercion from the US and China has really hit home in this, what some call the summer of humiliation, despite Europe being an economy of roughly equivalent size. And that really also hurts in an area where Europe is still very strong, manufacturing, where the trade war kind of is at its most intense, even though Europe's manufacturing as a share of GDP is 16% versus 11% in the US. And Europe has twice as many manufacturing jobs as the US. And so you see kind of across the board that Draghi's diagnosis, perhaps most importantly, the lagging innovation in Europe is really clear. And Draghi himself last week gave a quite harsh speech where he said that Europe's illusion that it could project power has been exposed because of its economic weaknesses.
And we had German factory orders this morning unexpectedly slumping, the most since January, Sander. Are we overestimating the rearmament push and the fiscal boost, and how much that could outweigh the tariff hit to the European economy?
Yeah, I think these are really kind of factors pulling in different directions. We obviously have Germany's fiscal revolution, the 1 trillion in investment in infrastructure and defense, which is a positive boost for European industry, but at the same time, the tariff hits are real. And China is a major player in terms of choking off European export markets and being a really formidable competitor on the European market for European industry. And you just have to look at China's trade surpluses, its manufacturing trade surplus, which is approaching $2 trillion. And this is really now in the same kind of sectors where Europe and Germany tend to excel, so cars, machine building, chemicals. And so all these factors are balancing each other out, but for now there's more pain coming. I would also add that, the German fiscal package hasn't really happened yet, right? It's quite slow moving. And so that support is still coming. But in principle, Europe should be able to replace some of the lost external demand from the US and China with domestic demand total exports to China and the US are only 4% of EU GDP. That's sizable, but it's not insurmountable.
Yeah, and that call for the self-sufficiency of the European economy, really fundamental to the Draghi report. But if we can also turn to France, because we were just discussing with Jean the consequences of the confidence vote on Monday. Do you see the political crisis becoming a debt crisis and an economic crisis for France?
I personally don't. I think the French crisis is really an issue of not being able to get its deficit under control on a French economy that's still diversified, that is, has underlying strengths, but France is really unable politically to exude a sense of control on this deficit. And I think it speaks a bit to a wider issue in European fiscal. So I think many of us are optimistic about Germany changing its fiscal policy in an environment where it can no longer rely so much on global trade. But at the same time, the composition of fiscal policies in the Eurozone, which has long plagued the continent, is not really improving. You don't want France to basically follow the German example because it has a much higher debt level. And there's some hope that the Nordics, Scandinavia, I would include the Netherlands, and Poland, which are really going to drive Europe's rearmament drive because they have the fiscal space for it. But there, that kind of engine is also still waiting to really kick in, which would provide some space for the high debt countries of Europe to maybe consolidate a bit. But as always, the composition is really the issue more than the overall debt level of the European continent.
And Sander, we had Jackie Ineke on yesterday talking about how Brussels is really just dragging its feet when it comes to the Capital Markets Union. Why do you think that is?
Look, I mean, Renew Europe, the liberal parties of the continent, have just released a report showing that of Draghi's recommendations, only around 11 or 12% are implemented. So I would agree with you, there's some feet dragging there. I'm personally a bit distraught by the fact that Germany is opposing UniCredit's takeover of Commerzbank, because in many ways, Europe's incomplete banking union is the trailblazer for capital markets union. And if we don't make progress on the former, it's hard to see financial integration on the latter. And I think many member states, and that holds also for other policy files, are sort of stuck in the narcissism of small differences. They're afraid of having more capital market competition, even though in the aggregate for all of them, it would be better to integrate capital markets. So there's some short-sightedness on that front.
Okay, well, there are so many recommendations in this report. I've got to ask you, and I only say this partly tongue-in-cheek, is the real reason why Draghi's report is so far from completion in Europe that it was just too big and too detailed?
I mean, in some ways, one could argue that. I think you could flip it around and say the value add of the report was that it actually provides a quite comprehensive, coherent roadmap for Europe to make progress. And I would argue Draghi at least didn't mince his words. I mean, the messages were punchy, the recommendations are actionable, and of course, there are just many issues that Europe is facing. So I don't think it's really a mistake of Draghi's strategy. One issue in some ways is that Draghi...
Okay, Sander Tordois, Chief Economist. The Stock 600 up 0.3%, the DAX up 0.2%. But all of this could change, of course, as we get payrolls later. But before that, we're going to talk about the oil market with an OPEC Plus meeting this weekend. So stay with us for the details. This is Bloomberg.
Bloomberg Screen Time is back this fall for year 3. We're bringing together the biggest names in business and pop culture, like Netflix co-CEO Greg Peters, Instagram boss Adam Mosseri, and Los Angeles royalty Willow Bay. We're going to talk about how sports is eating entertainment, check in on the state of the movie business, and get an update on LA after the fires from Rick Caruso and Irving Azoff. You should expect newsy interviews from industry leaders, meaningful business networking, and of course, great food. We'll feature some of the best chefs and food trucks from my hometown of Los Angeles. Tickets are available now. You should head to bloomberglive.com/screentime for details. I'll see you in Los Angeles, October 8th and 9th.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Morning and welcome to The Pulse. I'm Lizzie Burden in London, and these are your top stories. Jobs Day in the USA, stocks run a confirmation hearing. Plus, taking on NVIDIA. Broadcom's said to be helping OpenAI to design and produce AI chips. Well, we've got European leaders pledging to provide security guarantees for Ukraine if a ceasefire takes hold, with 26 countries prepared to contribute, including troops.
Cette coalition des volontaires qui
This coalition of the willing, which is a coalition for peace, has indeed today put on the table and clarified with a military and political commitment the contribution of the 35 members in order to provide these guarantees of peace and security to Ukraine.
Our Europe correspondent Oliver Crook has the latest. Ollie, Macron there keen to emphasise that the coalition of the willing isn't waging war on Russia. So what is its plan?
Yeah, so we got a little bit more clarity on what has been a very ambiguous, though very sort of a sensationalist idea about security guarantees for the Ukrainians in the day after process of peace and ceasefire from the Europeans. We've been talking about this coalition of the willing. We've been talking about this reassurance force. We've had very little detail on what it includes, what its purview is going to be, who's going to be involved. So we have a little bit more detail on that. So a reminder, this coalition of the willing is now a 35-nation-strong initiative that is spearheaded by Keir Starmer and Emmanuel Macron, assembled yesterday in Paris with Zelensky, as you can see right there, with two sort of main anything like this. But we should say that the two sort of nations that are spearheading this project are politically very fragile at home, and both have massive budget crises that are creating massive problems in the bond markets, and in the case of France, pulling down the government. So there's a big question of how to pay for it, to say nothing of the fact that any question of security guarantees is dependent on a peace deal on the sort of the day after, and we're still very much in the day of as far as the war is concerned. So what everybody is going to be looking to is Donald Trump as far as the war is concerned. So what everybody is going to be looking to is Donald Trump and whether or not he has the appetite to
levies on EU pork imports. Do you want to put some meat on the bones of this announcement for us?
Yeah, absolutely, Lizzie. I mean, listen, we thought the trade war was over, right? That Liberation Day had come and gone. We got all the negotiations that we had a fairly clear idea of the sort of one that is sort of going on between Europe and China. You'll remember that last year you had those massive tariffs imposed by the European Union on Chinese EVs, and now you have a preliminary imposition of tariffs from the Chinese, looking to put tariffs on pork specifically in the